We've just come off the back of a fairly strong week for the market, but if we do zoom out to the last month, we can see still the market hasn't reversed. We are looking at a large sea of red. A month in which we got many recession calls, JP Morgan 60% chance, Goldman Sachs 45%, and if we do zoom out even further to year to date 2025, we are still waiting for the market to turn green. Many companies still down double digits, but we do have to give a shout out to Berkshire Hathaway. Whilst the market is still looking in a poor form in the year, they're up 19%. Not only that, but they're up 35% on the year, and in fact when we do zoom out, they are now trading at an all-time high around the $542 mark, one in which Quant, Wall Street and Seeking Alpha do believe this is a company just to continue to buy. In fact, it wouldn't be a bad strategy to just dollar cost average into, and we do also notice investor sentiment is getting a lot better. Whilst we were in extreme fear at the beginning of April in the low single digits, we're moving out, and perhaps in the upcoming week we will move into neutral. But bear in mind, earnings season is still in full swing. We have many companies that are reporting next week. A few just to keep your eyes out for. We have Palantir reporting after the market close alongside Hims and Hers, as well as Realty Income for those REIT lovers. And of course we have AMD Super Microcomputers after the bell on Tuesday, and as you can already see, there are still many other quality companies to report. We also want to flag the S&P at the moment is trading at a valuation around 28 to 29, one you could argue is fairly high, and if we were to take a look at some of the averages it has been trading at, we are sitting around the 15 to the 16 mark. But again, who knows, no one has a crystal ball, and it could trade at a high valuation if you do believe this is such for a long time. And what that ultimately means is when we look at the S&P 500 on a forward valuation basis, there are still many companies that perhaps we wouldn't touch even after a fairly poor start to 2025, even though we have seen a bit of a recovery at least over the last few weeks. And in fact, we are now sitting on the longest winning streak for the market since 2004, something maybe you couldn't see at the heightened peak tensions of the tariffs that Trump had imposed on Liberation Day. We have gone past the point of the market just before that tariff drop. And also worth pointing out, we do have the upcoming Fed meeting next week where it is anticipated rates will be held, although the market overall, as well as Donald Trump, is wanting to see cuts as soon as possible, something that is now being priced in for the next meeting in June. Having said all of that, we want to cover 6 quality stocks that we believe are good potential buys this month. We're actually going to get into quite some detail with each one, starting off with Alphabet, one that whilst is down around 2% over the last year to date, it has still plummeted double digits, negative 14%. This is after their earnings, which we will briefly touch upon, reported last week. And over the last 10 years, nonetheless, they have outperformed the S&P up around 500%, still trading in the lower end of the 52-week range, with still a double buy from both Seeking Alpha and Wall Street, and this is one that does pay a dividend on the lower end at 0.5%, but a very attractive forward valuation at 17.2. Now, as highlighted, they did report their earnings not that long ago, where not only did we see growth of their top line at 12% year on year, but their fastest income stream, the Google Cloud, was up 28% year on year, fast surpassing that of Amazon. Even though they are a market leader, they reported substantially lower. And we can also highlight efficiencies to their margins, gross profit up 2 percentage points, operating up 2, as well as their bottom line net income up 9. And over the next 4 quarters, they are anticipating 3 of them to be growth, 100% historical track record, 4 out of 4 beats. And if you want to look towards their next full accounting period, December 2026, they're trading based on EPS at a valuation of 16.1, and we'll also show you the forward P right now around 17 to 18 is substantially lower than the average of 22.2. That is what we would indicate today as a severe undervaluation signal, coupled with the fact that when we take a look at this model, the blue tunnel here telling us the average of the PE as well as the expected fair price, the company is sitting below even the bottom end. Again, disparity noted, another severe undervaluation signal. Although they do get an F on the valuation grading, given the sector as a whole does sit much lower at 12.5, although you could argue the bucket that it has been put into isn't of high quality, and therefore it does deserve the 37% premium. In fact, you could argue it deserves a much larger premium, but the main takeaway here is on average their 5-year forward P, as we highlighted, does sit much higher. You're getting a 32% discount. In fact, no matter what valuation metric you look at today, Alphabet is trading at a severe discount to their 5-year average, although they are trading at a premium to pretty much every other valuation metric in relation to the sector. But as we said, we do believe they deserve the premium. Why do we believe that? Well, look, their growth does come in at a B. Year-on-year revenue 13%, forward-looking 12%, well above the sector in the low single digit. However, we do note over the last 5 years, they have grown their revenue at a faster rate, 18 and 15% respectively. And in terms of EPS, over the next 3 to 5 years, 16% growth anticipated. We noticed the sector much lower at 10, although their own 5-year a little bit higher at 17.9. And profitability also coming in very high at an A+, gross margin 59%, well above the sector at 53, as well as their 5-year at 56, and bottom line at 31%, well above the sector at 3, above their own 5-year at 25. So we're noticing efficiencies, something we always say, very important on this channel. Companies that increase both their revenue and their margins over time, whilst also increasing, as we see, cash from operations, 133 billion over the last 12 months, much higher than the sector at 342 million, but more importantly, significantly above their 5-year average at 89 billion. Now, we also want to uncover a bit more of the company's underlying metrics that we're covering today. For Alphabet, dividend safety does sit at 80, so it does look to be okay. We've covered these two undervaluation signals, but worth noting, they also increased their dividend in their earnings call at 5%. It is above the 4% we typically like to see, which is in line with inflation, so I guess you could say that is fairly decent, but ideally for this company, we want to start to see double digits, and their safety score for the dividend was in fact reaffirmed just a few months ago. A dividend cut does look unlikely, and if you want to see a key metric from the 07-09 recession, whilst no dividend was paid, no comparative data, they had plus 8% sales, significantly above the S&P average, which was in fact negative 12. And throughout the episode, we will focus on free cash flow data, as earnings is susceptible to manipulation by management through accounting. In terms of their payout ratio, below 60% is what we want to note for the majority of companies. Give us faith, they can offer significant increases to their dividends, and it is very low for the company at 16% on the trailing 12 months, so a little bit disappointed with only a 5% increase, but who knows what the future holds. Maybe they will start to ramp this up. Free cash flow, we want consistent growth over the long term, pretty much what we get with the company, and expected to continue to increase to $6.60 over the next 12 months. And then in terms of sales growth, very strong to note. Out of the last 10 years, 9 of them they've reported increases, 14% notably in 2024. And then for those that do want to see it on a numerical basis, very large increases over the period. Very important as well, not companies that just pay dividends, but those that return excess cash through share buybacks, something we have noted for Alphabet, 13.9 billion 10 years ago, 12.4 in the most recent quarter, and also similar to last year, they have recently announced a very large share buyback program, so we do expect that to continue. ROIC, 10% or more, give us faith, management are able to effectively allocate their capital, very strong over the last 10 years, now sitting at 26%. No complaints whatsoever. And as we mentioned earlier, we do want companies that do give us efficiencies, not only well above the minimum 12% on the operating margin, but has increased to 33%. And free cash flow, very consistent, pretty much what we would say a free cash flow machine. Net debt to EBITDA, final metric, and what we love about this, it highlights the balance sheet strength as well as dividend safety. Below 3 is what we want to see. Numbers below, or in fact we should say lack of numbers, tell us the number of years it would take the company to pay off all of their debt net of cash on hand. Not even 1 day for Alphabet, truly highlighting a very strong balance sheet. Now finally, before we get to the valuation, telling you here about the institutional ownership at 40%. They've sold 50 billion worth of shares over the last year, but they've bought around 89 billion, so definitely a lot more bullish over the last year, buying more shares. But in fact, in the most recent quarter, whilst they've sold 2.7 billion worth of shares, they've pretty much bought twice as much, 5.34, so very clear to see as well in the most recent period institutions very bullish on Alphabet. Now, our intrinsic value today comes to $226 derived on the DCF model. Now, we have here the free cash flow year on year, including the most recent year. Average growth 20% year on year. We've gone for 12% moving forwards, which is significantly below. And in fact, we have a low, medium, and high 10, 12, 14%. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether for this company or any others. But based on the growth rate and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, 226, indicating 39% upside. Now, we'll also show you, for those that do believe it should be lower for transparency, at 10%, 197, upside of 21%, and for those that do believe it should be higher at 14, 259, 59% upside. As typical on the channel, we will take through the medium rate, where we're not just done there, because we always apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $203, but we keep going till it's near the current trading price. Now, not a 30% MOS just yet, we'd say 158, but you are getting pretty much between 25 to 30%. Wall Street themselves see this at 205 over the next year, indicating 26% upside. As always, give us your thoughts as we go along, your own thoughts, and whether you see them as a buy, hold, or sell. But we'll also flag here, for those that believe 10% is the more appropriate rate, that you are still in fact getting a margin of safety. And as we keep going, not 20% just yet, but you're getting somewhere between 15 and 20%. And as we said, Wall Street, 26% upside. We'll even go one step further today for those that believe 8% is more appropriate. Now, at a 10% MOS, you're not getting that just yet, but if you see only 8% growth of future free cash flow for the company, you are pretty much getting 5% margin of safety. And this is just to highlight that this company, we do believe, is incredibly undervalued. Today's video is sponsored by Snowball Analytic, and they are much more than just a portfolio tracker with a ton of features that you can use on the platform. We also like the fact their user interface is very easy to use, very quick to consume. You can see your portfolio broken down on a sector by sector basis. You can note which companies have performed very strongly that day, which are the top gainers or which are the top losers. It's also incredibly friendly for those who do love dividends. You can see a lot of information. For example, what is the yield on cost? You can see which companies are actually driving not just the dividend within your own portfolio, but also the growth, and also understanding whether or not some of the companies that you do hold have some risky dividends. It also shows you the average annual growth, which is very interesting to note. One of the cool features here as well is that you can compare your portfolio over the long term against the S&P, and for maybe those that want a bit of inspiration about what companies they should consider, we also like the detail that it goes into for each company, not just the high level metrics, but you can take a look at the income statement. It also has information on the balance sheet, the cash flow, as well as many statistics which we do like to cover here on the channel. So you can click below, and the great thing is right now you can grab a 14 free-day trial. The next company we're moving on to is the Coca-Cola company, one that you could argue is fairly defensive, especially if you do believe a recession is inbound. In fact, when they did release their latest earnings, which we will briefly cover, they said they don't envision too much of an impact to the overall business, something we didn't hear in fact from Pepsi, who did lower their guidance. Now, they're up 16% over the last year, year to date up 15%, over the last 10 years up 75%. Bear in mind, this doesn't include dividends reinvested, so your return would be higher. Trading at the upper end of the 52-week range, a buy from Wall Street, a hold from Seeking Alpha, a yield near the 3% point, a forward P around the 24 mark, and in just their latest earnings, we can see their top line revenue was down slightly by 2%, although we did notice large efficiencies to in fact their operating margin up 14 percentage points, and 2 percentage points for their bottom line net income. Now, over the next 4 quarters, they do anticipate 3 of them to be growth with a 100% historical track record, and based on 2026 numbers, they are trading at a forward P of 22.4, but right now the forward valuation as well as the dividend yield both aren't too dissimilar from the averages, so this would in turn give us a reasonable signal, and that is something that we can also clarify when we take a look at this model. It is pretty much trading around the midpoint, although as you can see, at least for the last last 12 months, this isn't one that we do typically see trade in fact below the blue point, and they do get a D- on that valuation grading. Again, you also need to consider whether or not companies do deserve a premium. As the sector is trading lower, you're paying in fact 48% more, and as we did just highlight seconds ago, the company is pretty much trading in line with this average, so it does remain to be seen whether or not it deserves a premium, given it does trade substantially above the sector, and in terms of their own 5-year averages, not too dissimilar when you do look at a wide variety of valuation metrics. Now, their growth does come in at a C+, so revenue year on year 2%, pretty much in line with the sector, although over the last 5 years they have grown at a faster rate at 6%. Forward looking 3.4, sector itself 3, and their own 5-year again sitting a bit higher at 5.4. But if we do take a look at the EPS over the next 3 to 5 years, expected growth at 6, pretty much in line with the sector and their own 5-year average. Although one area where they do stand out is their profitability at a B+, gross margin 61%, well above the sector at 36, also slightly above their own 5-year at 59.7. Bottom line, 23%, again well above the sector at 4, and pretty much again in line with their own averages. Cash from operations, though, we do in fact notice 1 billion over the last 12 months. Sector does in fact sit a bit lower at 927 million. However, we can in fact see their 5-year average does sit a lot higher at 10.6 billion, something that we would investigate if we were to do a deeper dive. And looking at their dividend safety score, it does in fact sit at 80 safe, and we do notice a few months ago they did in fact increase the dividend at 5.2%. So when we take a look at this company in terms of their safety, again reaffirmed just a few months ago, dividend cut for the company is unlikely. And in terms of how they performed in the last recession 07-09, increased the dividend, above average growth -5%, outperformed the S&P -31, S&P itself -55, and we can in fact see this is a company that on average over the last 10 years has been increasing it at 4.7, slightly above inflation. But even more impressive, they are a dividend king, 62 years of consecutively increasing it whilst paying a dividend for the last 105 years without a reduction. Now, their free cash flow payout is definitely one to keep an eye on, because below 70% is what we prefer for the industry, but in 2024 and expected over the next 12 months, it is sitting above the 100% mark. And what this tells us is that management are paying out more in dividends than they're generating in free cash flow. So again, definitely something we would say to have on your radar. In terms of free cash flow per share, not as consistent as we would like to see, in fact very inconsistent, although over the next year it is expected to increase to $1.37 from the previous $1.10. And if we move on to the sales growth, it does in fact look very, very mixed. Just over the last few years, we do get some nice growth, but it has started to slow down. Definitely something we would say to factor in to your overall investment thesis, as well as your margin of safety, and that's also reflected on the total sales. Now, shares outstanding, it isn't a company like others that we will cover and some that we have previously on the channel that are aggressively doing share buybacks. It is pretty much flat over the last 10 years, no share dilution, but also no shares decrease notice. Then when we move on to the ROIC, pretty much consistent around the 12% point, so no worries there, 14% on a trailing 12 month. And in terms of the margins, we do get a minimal efficiency here, 23% 10 years ago to now sitting at 30, well above in fact the minimum. Free cash flow margin as well, looking fairly strong, 10% in 2024. This then leads us to the net debt to EBITDA, which for this industry we want below 4, and that is exactly what we noticed, 2.31 on a trailing 12 month, and expected to go lower at 2.13 over the next year. So it is understandable why this company, we do get that dividend safety score. And institutional ownership sits at 70%. We get 12.5 billion worth of sales over the last year, but we get a lot more buying at 18 billion, and that's also noticed in the most recent quarter, more than twice as much buying from institutions than they were selling. So very bullish from the institutions on Coca-Cola Company. Now, intrinsic value today gets to $70. Now, given the share price isn't that far off, what we're effectively saying for this company, it is trading near its fair price, something that we noticed when we were taking a look at the other valuation models. Now, this is a company that you could argue is fairly defensive, and if there is a recession inbound, it could be one to have in the portfolio, but also one that, as we said, some investors pay a premium for, some investors happy to in fact pay their fair price, and for those that did want to see a margin of safety, at 10%, a buy at $63, at 15 around 59, and at 20 around 56. In conclusion though, for the company, yield near 3%, trading around this fair value. Wall Street themselves, with the buy rating, do have this at $80 over the next year, with upside of 11%. As we said, give us your thoughts below, buy, hold or sell. Now before we move on to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a recently released copy of severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year, as well as another recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to UNH, which has been absolutely battered after their latest earnings. They are down around 19% over the last year. Year to date, they're down around 21%. That is in 2025, 1/5 of their market cap just wiped off. Yet over the last 10 years, they still have massively outperformed the S&P, up 246%, trading at their 52-week low, a strong buy from Wall Street, a buy from Seeking Alpha, a yield of over 2%, and a forward PE sitting at 15. In terms of the next 4 quarters, they only anticipate one of them to be growth, and we can see over the last 4, 75% track record, with the notable miss being that latest quarter. And if we look towards December 2026 earnings per share estimate, the forward valuation does come to 13, and we get a severe undervaluation signal. Forward PE, as highlighted here, well below the average of 20.2, and the yield of 2.1, not only above the 5-year rolling of 1.42, but the highest they have offered over the period. And again, another confirmation of severe undervaluation. We do get disparity between the 2 points, and quite a large one noticed here as well. In terms of valuation, even though they get an overall D, we do in fact notice they're now trading below the sector. You are getting a 12% discount, and as we highlighted, they're trading around 28% lower than their own 5-year average, something pretty much consistently noticed now for United Health Group. No matter what valuation metric, not only is the company trading at a discount to their 5-year, but also now a discount to the sector. In terms of growth, they do get a D-, year on year 8%, forward looking 9.5%. That is still above the sector at 7 and 8% respectively, although only marginally lower than their 5-year at 10.5 and 9.5. And when we look to the earnings per share, 7.7% over the next 3 to 5 years. That is below the sector at 10.5 and their 5-year at 13.4, which is probably driving the overall D grade on the growth. Profitability does come in at an A+, gross margin 22%, below the sector at 60, below their own 5-year at 24.5. Bottom line 5.4, well above the sector, which is losing money, -3, in line with their own 5-year at 5.6. And when we look at their cash generated from operations, 28.5 billion, sector burning through money, -12.5 million, and also above their own 5-year at 24 billion. Now, dividend safety does come in at 90, very safe, and they also increased their dividend last June at 11.7%, and it was in fact reaffirmed after their earnings that the dividend is still very safe. Although downgraded from 99 to 90, it still highlights that the dividend cut is highly unlikely. And if we do in fact get to their key metrics, they maintained the dividend in the last recession, plus 5% recession sales, and they marginally trailed the S&P, -63%. But one thing we love about this company is very consistently increasing the dividend at a double-digit rate, 19.3% over the last 10 years, whilst increasing it for the last 15 and paying a dividend for the last 32 without a reduction. Free cash flow payout also looks very good, below 60% consistently, 31 on a trailing 12-month. Free cash flow also looks very good, consistent increases over the longer term, and whilst we did get a drop from 23 to 24, a large increase is anticipated over the next 12 months to $31.30, and we do in fact notice from the sales growth, very strong, well above the minimum 3 to 7% that we want to see. In fact, 3 to 4 is just to keep up in line with inflation, and you can see that in fact reflected on the total sales. Whilst also, although only very marginally, do we see some share buybacks. Maybe we will see this ramp up if management do believe the share price is looking very attractive. And the ROIC, no complaints whatsoever, very consistently around the mid-teens, 14% from the latest quarter. With margins, whilst in fact not looking above the minimums, when we do compare it to the sector as we have just done, there are no worries to point out, and free cash flow pretty much consistently straddling around that 5% point. Net debt to EBITDA also looking strong, which is probably why, in combination with the free cash flow payout, we do get the very safe score. It's sitting at 1.2 on a trailing 12 month, expected to go a little bit lower over the next year. Institutional ownership looking good at 88%, 40 billion worth of selling, 47 billion worth of buying, and a lot more buying in the latest quarter, 6.12 versus 1.26 selling, something we maybe see continue in the next quarter if institutions do believe it's severely undervalued. But for now, we can highlight they do like this company a lot. They are very bullish. Now, intrinsic value gets to $558, which will signal after this large drop a lot of margin of safety. And if we keep on going, you're getting near 30% at $391. And whilst 25% is 419, we would say it is leaning more towards a 30% MOS. And Wall Street themselves very, very bullish, $565 even after the drop, even after their earnings. They anticipate 42% upside over the next year. But as always, give us your thoughts whether or not you have been buying on the dip, or in fact you do believe this is a falling knife that will only continue to go lower and lower. We then move on to the Toll Brothers, which is down 14% over the last year. Year to date, down 17%, but over the last 10 years, they have outperformed the S&P up 185% on quite a significant pullback towards their 52-week low, with their 52-week high at 170, and we notice a double buy from Seeking Alpha in Wall Street, a yield around the 1% point, and a forward valuation at 7.5. Now, over the next 4 quarters, they do expect growth from 3 of them, whilst having a 75% track record. Most recent quarter, we did see a 30-cent miss, and if we look towards October's earnings per share in 2026, they're trading at a forward valuation bang on 7, and both their forward P and the current yield aren't that far off the 5-year rolling average, so this would be a reasonable valuation. And when we do take a look at this model, you could argue it is slightly outside of the lower point, or in fact just about in. Either way, this does look like a potential undervaluation signal. And on the grading, while they do get a C-, we can see the sector as a whole does trade much higher at 14.9, so you are getting a 50% discount, but also, as we highlighted, marginally lower than the 5-year by around 12%, and that is something that is pretty much consistent across the valuation metrics. For the large part, this company trades at a discount to the sector, but also at a discount to their own 5-year numbers. Now, growth, they do get a D. Revenue year on year, 6%, and forward looking 3.5%. They are marginally above the sector at 2.5% and 3% respectively, but lower than their own 5-year at 8% and 6%. And if we do take a look at EPS, another company which is penalized for this metric for the overall grading, 5% over the next 3 to 5. We do see the sector higher at 11, and also their own 5-year at 12.4, sitting much, much higher. Profitability does come in at a B+. We do see the gross profit, in fact, at 28%, below the sector at 39, above their 5-year at 24. Bottom line, 14% above the sector at 4 and above their own 5-year at 11. So we are noticing improvements, efficiencies in their profitability, and cash from operations around 900 million above the sector at 278, but a little bit below their own 5-year at 1.07 billion. Dividend safety score coming in at 70 safe, whilst also increasing the dividend just a few months at 8.7%, and we can in fact see it was reaffirmed in March. Dividend cut is unlikely, and key metrics, we do have to bear in mind that if a recession is due, from the last one, sales were down 46%, with, as we said earlier, the average for the S&P at -12. In terms of dividend growth though, on average over the last 5 years, they've been increasing at 15.4% year on year, whilst increasing the dividend for the last 4 years and paying one for the last 7 without a reduction. Free cash flow payout looks very, very good, very low, in fact 12% on a trailing 12-month basis. Free cash flow per share, whilst not massively consistent, it still does look good over the longer term, and a large increase anticipated over the next 12 months to around $15 per share. And the sales growth, a little bit inconsistent. You could argue the industry is cyclical, which is noted through the numbers. But again, if you do zoom out to over the last 10 years, they have more than doubled their top line. One thing we can note is aggressively buying back those shares outstanding. Again, that is one way of returning excess cash to investors. Nearly half from 10 years ago at 185 million, now sitting at 104. Another one that we may see ramp up those share buybacks if they do believe the company itself is looking severely undervalued. And ROIC, nice to see the increase over time, now sitting at 15%. And the operating margin, we do get that efficiency noted, 12% 2015, now sitting at 19%, and no complaints on the free cash flow margin. Net debt to EBITDA, again, nothing really to note here because it's well below 3, sitting around 1 on the trailing 12 month. A little increase noticed over the next year, but again, in combination with the payout ratio, dividend looks to be safe and balance sheet also looks to be secure. Institutional ownership sits at 92%, 1.7 billion worth of selling, a lot more of buying, and that's also reflected in the most recent quarter, so institutions bullish on the company. And our intrinsic value gets to $153 as we keep going in terms of a margin of safety. You can in fact see one of the largest today at around 30%, up to $107. Wall Street themselves, 141 price target, 34% upside. Give us your thoughts. Is this under the radar company a strong buy, or maybe for whatever reason not one that fits your portfolio? We then move on to American Express, up 19% over the last year. Year to date down 7%, over the last 10 years outperforming the S&P, up 251%. Trading in the midpoint of the 52-week range, double buy from seeking alpha on Wall Street, yield of 1.22% and a forward P at 18.2. Now we can see their latest earnings revenue was up 7% from the same quarter last year, and their deposits are up around 9%. They do also anticipate double-digit growth to the EPS over the next 4 quarters with a 75% track record, and December 2026 numbers giving a forward valuation of 15.9. Now similar to other companies today, the current forward valuation and the yield is in fact around the 5-year average. That is one reasonable signal, and that's pretty much also confirmed on the blue tunnel. The other thing to also point out, nice to see it is increasing over time, something you want from all of your companies, for them to be worth more as time progresses. And whilst they do get an F in fact on the valuation, as the sector does sit a lot lower, and you are paying in fact a 73% premium, as we've highlighted, around the 5-year average, but a very small 8% discount. Though you could argue American Express is worth the premium. Growth grade at a B+, year-on-year revenue 9%, forward-looking about the same, above the sector which does sit at 6 on both accounts, and we can see their own averages not that far off. And if we move to the EPS, expected 14%, that is well above the sector at 9.7, but quite some way below their own averages of 20.6. Profitability also coming in at an A+, gross margin 64%, above the sector at 59, only slightly above their 5-year at 63.8, and cash generated from operations 13.3 billion, above the sector at 161, but we can see slightly below their averages of 14.4. Dividend looks to be good as well with an 80 safe score. They also increased the dividend beginning of this year at 17.1%, and it was in fact reaffirmed just a few days ago. The dividend cut does look to be unlikely, and in the last recession they maintained the dividend, didn't increase, also didn't cut. Below average growth massively trailed the S&P. The stock price dropped 82%. And if we do look at their dividend growth, very, very juicy, 10.7% on average over the last 10 years, although they've been increasing the dividend for the last 3 consecutively, whilst paying one for the last 29 without a reduction. No complaints on the free cash flow payout, well below 60%, in fact 18 on a trailing 12 month. Free cash flow does look a little bit inconsistent. We're not getting that growth that we do want to see over the long term, but nonetheless still does look fairly healthy. And sales growth, we do get a little bit more inconsistency, but at least from over the last 4 years, growth does look to be strong, and that is noted when we do in fact zoom out. They've increased their top line pretty much double over the period, whilst also again another company aggressively doing share buybacks, reducing it from 1 billion to 708, so that is a 30% reduction over the period. And ROE for the company does look very good, well above the minimum 10% that we want to note, and free cash flow margin looking very healthy, well above the minimum 5%, 20% in 2024, and no complaints whatsoever on the net debt to EBITDA, pretty much 0 in the more recent quarter. 84% institutional ownership, 9 billion worth of selling, 13 billion worth of buying, and more buying in Q1 than selling, so another institutional favorite, a lot more bullish than bearish. Now intrinsic value gets to $325, again another one with a nice margin of safety. As we keep going, you're getting bang on 15%, and Wall Street themselves envision 14% upside over the next year, $315 price target. We then move on to Meta Platforms, also released their earnings not that long ago, up 35% over the last year. They're now green on a year-to-date perspective, up 2%, and over the last 10 years, up 660%. trading in the midpoint of the 52-week range. Strong buy from Wall Street, a buy from Seeking Alpha. Yield, although fairly trivial, 0.35%, and a forward valuation at 23.5. And we can see their latest quarter revenue up 16% year on year, whilst also noting efficiencies to operating profit up 4 percentage points and bottom line up 5. Although they do anticipate over the next 4 quarters only one to be growth to the EPS, 100% track record, some very large sizable beats, and December 2026 numbers, forward valuation 20.9. Now they're also trading pretty much in line with their historicals, so another reasonable signal, and that is also confirmed when we take a look at this model, pretty much around the midpoint, but again one that doesn't typically come below the point for severe undervaluation, although something we did note just over the last few weeks. And very similar to Alphabet, while the valuation does come in an F, the sector is a lot lower, we do believe it deserves that premium, which currently sits at 87%, and as we highlighted, pretty much in line with their 5-year average. Growth while coming in at a C+, year-on-year revenue 19%, forward-looking 16%, well above the sector at the low single digit, but pretty much in line with their own 5-year average. And if we do get to the EPS, coming in at 18%, well above the sector at 10 and a little bit higher than their own 5-year at 17, so premium definitely warranted. And that's also reconfirmed when we look at the profitability grade of an A+. Gross profit margin 82%, sector at 53, their own 5-year at 81, so looking better on both accounts. Bottom line 39%, again well above the sector at 3, well above their 5-year at 30, and cash from operations very strong, 96 billion, well above the sector and also significantly higher than their own 5-year at 57 billion. Now dividend, while in fact fairly trivial, they do get a safe score of 70, whilst also increasing it pretty much in line with Alphabet at 5% a few months ago, and we can in fact see no surprises given they've only just recently initiated. Dividend cut does look to be unlikely, and their sales very significant in the last recession, 154%. Remember, S&P was negative 12. No worries on the free cash flow payout, is very low, 10% on a trailing 12 month, which does make it disappointed. We did only get a fairly trivial increase. Free cash flow fairly consistent over the longer term, although a drop is anticipated over the next 12 months. And then we get to the sales growth, very, very strong, nearly double digit every single year, very impressive, 22% in 2024. And we also notice extreme growth to their top line over the period, whilst also doing a little bit of share buybacks over the period. And then when we move on to the ROIC, again, another one with no complaints whatsoever, 24% latest quarter, also increasing from the period. And margins looking very strong, whilst a little bit inconsistent, still very, very high. And again, free cash flow margin looking like another free cash flow machine. Finally, net debt to EBITDA 0, very similar to Alphabet, not even taking them one day to pay off all of their debt net of cash on hand. And institutions holding 80% ownership, 47 billion worth of selling, pretty much twice as much buying, and significantly amount more buying in Q1, 18 billion versus 2 billion of sales. So when we do get to our intrinsic value at $699, bear in mind this is derived from the lower rate. We do want to be conservative, but if you just want to see at the 12%, and we can show you here as well, it will come to $805, 35% upside, one that we can see if they continue with another strong quarter of earnings, that this could be upgraded to that point to $805. As we said though, we do want to take through the lower rate, more conservative at 10, and also bear in mind you can grab a copy of this model to run through your own numbers. Doesn't have to be these numbers on screen or in fact meta platforms. And when we do get to the margin of safety, as we do in fact keep on going, not 20% just yet, you're getting pretty much bang on 15%. Wall Street themselves see $720, upside of 21%. Give us your thoughts whether you see this as a buy, hold or sell. We also just want to very briefly highlight a few other companies that we did have in consideration for the episode today. We have Procter & Gamble, we have Salesforce, S&P Global, as well as Apple, all of them for different reasons of their own. But if any of these other companies do interest you for a deeper dive from what we have just seen, then let us know and we can put them in another episode, maybe a part 2. And as always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.